Doing section 2.7 on calculating income. If you're following along in your manual, this section will start on page 45. So let's start by reviewing the various types of income that you may see from your clients, and then we'll talk more specifically about documenting these different income sources. So you may have the traditional employment information. So you've got someone who just works a traditional job. You may also see Social Security income, and this could be various forms of Social Security. It could be SSI, which is Supplemental Security Income. It could be standard retirement Social Security. You might also see Social Security disability income. You may be dealing with child support or alimony or various retirement sources of income, and that could be a pension, that could be an annuity. There's a lot of various sources of income for retirement funds. Any other sort of income will have to be consistent and verifiable to be counted. You're going to run into different requirements by different lenders. Some lenders require for employment. They want to see 2 years of consistent income. One of the problematic areas, and one of the items not listed here, is you may have clients that you run into that are self-employed. So self-employment income is also able to be counted, but again, it's got to be consistent and verifiable, which verifiable generally means that they're reporting it and paying taxes on that income. So we'll talk about each of these in more detail. Let's start by calculating various sorts of income. And usually calculating income is going to be hardest when you have a client with pay stubs. Many of the other sources of income are simply going to be monthly. For instance, Social Security or pension incomes. A lot of the child support or alimony might be weekly, but it's really a little trickier when you're dealing with jobs because there's so many different pay schedules that you're going to run into. So we've got them listed here, okay, monthly. Occasionally you'll have jobs that do pay out on a monthly basis. Semi-monthly, which we've listed here as 24 pays in a year. So these would be people who get paid on the 15th and the 30th or the 7th and the 22nd. So it's twice a month. So you end up with 24 pays a year. Biweekly, there's always a lot of confusion with biweekly. The only difference between biweekly and semi-monthly is look at the number of pays that you get in a year. Under biweekly, you're going to have 26 pays a year because since there's 52 weeks, and biweekly, meaning they get paid every other week, 52 divided by 2, you end up with 26 payrolls when someone's paid on a biweekly schedule. So it does make it a little harder. You can see that the same salary paid out biweekly is going to equal a larger yearly income because they've got 26 pays instead of 24 in the semi-monthly. If you have someone who works hourly, what you need to do is just calculate their hourly rate of pay by the number of hours that they work. And we'll go into more examples here, but hourly can be tricky because they may work varying hours. They may have 20 hours one week and 30 hours the next week. So you're really just going to have to calculate the average number of hours that they work. Another tricky thing is if you have someone who has seasonal work, and this could be a teacher. Maybe they only work 10 months out of the year. It could be migrant workers who just work during the farming season, and so they might just work 10 or 12 weeks a year. There's a lot of part-time jobs that might just be seasonal. That could be somebody who maybe they just work a part-time job over the summer, or maybe they're a tax preparer. So during tax season, they work seasonally. If this is the case, what you can do to average it out is because we know that there's 52 weeks in a year divided by 12 months, so there's 4.33 weeks per month if you average it out that way. So you just take the client's information and divide it out that way, and then divide it by 12 so you can figure out if they did work all year long, how to spread it out on a yearly basis. Don't forget that if you have a client that has non-taxable income, it's important to remember that some lenders, in fact most lenders, will gross it up in order to qualify them for a loan. And the reason that they do this is that it really helps these borrowers. Since they're receiving non-taxable income, you want to be sure that they get to count all of their income just like anyone else does. Well, with non-taxable income, their gross and their net is the same because they don't have to pay tax on it. So this is a way to kind of level the playing field and make sure that they get the benefit of qualifying for just as much as somebody who has taxable income. So instead of just counting their net and their gross as the same amount, we know what their net income is. We multiply that by 25%, and 125% of their net is going to be what's counted as their gross income. So this is what's known as grossing up non-taxable income. And a good example of this might be someone who receives a disability check. Their disability check is $1,000 a month. Well, it's not really fair for them to only be able to qualify for a house based on $1,000 a month when you might have a worker who earns $1,500 a month. Their net pay is $1,000. So if you compare the two, they both have the same net pay of $1,000, but the worker actually gets to qualify based on $1,500. So in order to make it fair, we would gross up that retirement or disability income, and then instead of $1,000, they would qualify for a payment, or their amount that they would be used to qualify for would be $1,250. So it's a way of just trying to give them the benefit of being able to qualify the same way a person would that has taxable income. So that's the idea behind grossing up. Now when we look at pay stubs, and I'll give you some examples of each of these, this can be challenging, and I never really understood how challenging until I got into counseling work. And I realized that everybody's pay stubs are really different. And I would never understand how, when I was talking with a client and I said, well, you know, explain to me your pay system. Sometimes it was hard for them to explain it. And that's because there's a lot of different pay schedules out there. When you look at pay stubs, there's a lot of different reporting and formats. So sometimes it can be hard to learn to know what you're looking for each of these. But here are the key things you're going to try to find on a pay stub. You want to try and figure out their pay schedule. Are they weekly, semi-monthly, bi-weekly, monthly, hourly? Somewhere you should have a clue. It probably won't really tell you semi-monthly or bi-weekly, but you should be able to look at the dates and kind of figure that out. By looking at the pay period, you can also see, if they get paid on the 7th for what work performed. And that way you can see the pay period covers what period of work time. It also gives you an idea if the client is earning overtime or bonuses, because you can look at the year-to-date, and there may be a calculation there that you can see. It's also important to take a look at the deductions that they have coming out of their payroll. This really can be valuable information. And frequently clients are not necessarily familiar with all of the deductions that they have coming out. They kind of get used to it. So they don't even pay attention anymore to the things that are getting deducted. So this is where you can play a really valuable role in talking with them. And that way maybe there's some deductions that could be adjusted. Maybe they could have higher take-home pay if they made some adjustments there. So these are the things that you're going to be looking for when you're reviewing a client's pay stubs. As you look at the pay stubs, you're trying to figure out what's their pay schedule. As I mentioned, bi-weekly, weekly, semi-monthly, trying to figure out how they get paid. If their hourly rate is listed, that can be useful information, particularly if they're on an hourly payroll. It's also going to be important to figure out the gross pay and the net pay. For purposes of pre-qualification for a mortgage, you're always going to be dealing with the gross pay. And remember, if you have somebody who has non-taxable income, you're going to gross it up by 25% to allow for the fact that it's non-taxable income. But most pay stubs will spell it out for you. Here's the gross pay, here's the deductions, and here's the net pay for the pay period. And this will give you some information to calculate what is their average monthly income. So the pay stubs, although they can be hard to really figure out how to read them, where to find the information, it's definitely something that you're going to be utilizing a lot as you go through calculating income. So here's an example of a pay stub. And so let's look at this pay schedule together. So the first thing you'll notice is you can see their hourly rate listed down there in the bottom left-hand box is $8 an hour. The hours are listed, 80 hours. And what's nice about this payroll is it tells us that they are biweekly as opposed to semi-monthly. So remember, biweekly means every other week, so they're actually going to have 26 payrolls a year when we go to calculate that out. So this pay stub is a good example of a pay stub where it's really going to be spelled out clearly for us, and it's going to be easy to figure that out. Now, on this particular pay stub, it gets a little trickier because now we have someone who has received overtime. So if you look at this pay schedule, you can see they've got 40 regular hours at $9 an hour, but this week they also worked 8 hours of overtime and they got $13.50 for the overtime hours. And to really make it a little more complicated, they also get a mileage reimbursement. So they had 118 miles at 30 cents a mile. You can tell this is back in 2013. Mileage was cheaper then. So this would be a little more difficult to calculate because you would have to look at the year-to-date and figure out, well, do they have a lot of overtime? Now this particular pay stub is from the month of January, February, like the last week in January. So it could be that they have overtime all year long because already the first month of the year they have had 8 hours of overtime, and you can see that the current overtime was $108, but if you look at the year-to-date, they've got $445. So it looks like they're fairly consistently getting overtime. And the same thing with mileage. If you look at the year-to-date, that pretty much would tell you that they're fairly consistently getting some mileage. And it does break out the gross income and then the net income for us. Now this pay schedule also has regular pay, but then we also have over on the right-hand side, you might see something similar to this. If someone is getting sick pay or they took a vacation in this pay period. So under earnings on the right side, you can see under the SIC, so under their sick time, they got paid for 7.5 hours. And so their earnings for those 7.5 hours came to $73.50. Their work hours were 155 hours. So this gives you some breakdown if they're getting paid for sick time or they get some vacation pay calculated in there, you'll be able to see that. If you look down at the bottom, this is where you're going to find their current earnings. On the left is going to be their gross minus the deductions, taxes, and other deductions that they have. Then you can see the calculation for their net pay. And this person is a pretty good example of someone who has a lot of work benefits deducted. They've got life insurance, dental insurance, disability, vision insurance, must be some sort of a retirement plan or another benefit plan called a surety, a 401k loan. Okay, so that's going to be something important to talk with them. Plus they have a 401k deduction and a retirement plan. And then they also have some dependent life insurance. So this is a good example of someone with an awful lot of payroll deductions. Their payroll deductions are actually coming up to more than what the taxes were that were deducted. So you would want to pretty carefully go through this and get some information about why this client has all these different benefits and if they are affordable. If they're pre-qualifying for a mortgage, remember they're going to qualify based on that gross income. But when we do their budget, and that'll be in a further unit in this class, we'll be talking about net pay, because that's really all that they have available to pay their bills. Even though they're going to be qualified based on that gross amount, we've got to remember that the net pay is really what they have available to pay those bills. So let's go ahead and talk about documenting income. So in this section for 2.8, we're going to be talking about how do we document and review their income, and what kind of documentation do we have for different income sources. Are we talking pay stubs or bank statements? So we'll be talking about all these different sources during this section. Let's talk about bank statements first. Bank statements are a really important tool that you can use to figure out a lot of things about a client's situation. So the first thing is, if they don't have any bank statements, they're not banked. So you want to find out, how do they cash their checks? How do they pay their bills? Are they getting money orders? So if they have a bank statement, you know that at least they've already got a bank account established. That may also indicate if they have a savings account. And when you look at those bank statements, you're going to get a lot of clues to their spending habits, particularly now because a lot of people use their debit cards. And the debit cards, because they're being used for, these days, just about everything, you can really see if somebody's going to the gas station and they're buying soft drinks, if they're going to Starbucks, if they're going to fast food places or out to eat. Because the debit cards give you all that information, if they're using a debit card for everything, it's pretty easy to itemize out, well, here's how much you spend on gas, here's how much you spend on fast food. And so it gives you a lot of really useful information to figure out where their money is going. Also, when you look at bank statements, you're going to be able to see if they've been bouncing checks. Do they have NSF fees because they've overdrawn their checking account? Do they have payments that are automatically being made to creditors? Those automatic deductions, again, people kind of frequently forget about these things. They might forget that they've got that automatic deduction. So you'll find a lot of really important information on those bank statements that'll be very useful to you. A couple other things to know about bank statements. Kind of goes without saying, but don't forget to turn it over. Sometimes there's a page 2, and so you want to make sure that you're looking at both pages. It should be indicated if the client has multiple bank accounts. So if they do have checking and savings or multiple savings accounts, you'll be able to see what debts are being paid, or are the debts being paid. And you'll see some spending trends that'll be really useful. Again, if you notice that they're going out to eat a lot. You really can just draw a lot of information from these bank statements that can be helpful to start a conversation. And frequently this is something that a client, they may not even realize that they're actually going out to eat 3 times a week. So they think it's once a week, but when you really add it up, you know, they went out 15 times this month. And again, you're going to be looking for any overdraft fees for NSF checks, because that really just indicates an extra expense for poor money management. So that's something hopefully relatively easy to correct. Here would be income tax statements and also W-2s. So what can you find on an income tax statement? Lots of information. You're going to be able to see how many dependents they're claiming, different types of income that they have. And again, sometimes people get so used to income that they forget, oh yeah, you know, every year in March I get $2,000. So this will let you see if there's other types of income. It also gives you an idea if they've had an increase or a decrease in their income. So you want to try and at least go back 2 years to see kind of what the trend is. And that way you have a chance to compare the income on the tax return with whatever W-2s that they've provided, so you can see if the income's higher, but they're showing you, you know, a lower amount on a W-2. Maybe they've been working an extra job, or they forgot to tell you, oh yeah, you know, during the summer I worked this extra job. So looking at the tax return and checking the income will give you some useful information to double check the income. Keep in mind, there are a lot of people who work and do not claim it on their income taxes. And if they do not claim it on their income taxes, it does not exist for purposes of qualifying for a mortgage. So sometimes that can be a little tricky of a conversation with clients, because everybody has kind of gotten used to, if that's what they're doing, they've gotten used to counting that income for spending, but they've never really made it legitimate income. So when they go to qualify for a mortgage, if they've never counted that source of income, not only is that illegal, but they're also going to hurt themselves when it comes to qualifying to buy a home because they're not going to be able to count that income since they haven't documented it. Another thing that will show up on the tax return is if they're already a homeowner. So again, you'll find a lot of useful information there. When you look at the tax returns, you're going to want to take a look and see how many dependents they're claiming. If they're not claiming all of their dependents, find out why. Maybe they're divorced and there's an agreement that they alternate years or something like that. So take a look at that and ask those questions, because that's going to also influence their tax refund. So maybe their income tax refund is bigger every other year because that's the year that they're allowed to claim all the kids. Check the gross income, because that's what's going to be showing up on the tax return. Okay. Check and see if there's any other deductions that would indicate that perhaps they owned other real estate. And take a look at the refund that they're getting. If they're getting a big refund and they're not using it for a specific purpose, like deliberately trying to save for a down payment, might be that you want to talk with them about adjusting their withholding so they had more throughout the year. So take a look and see what their refund has been, and if it's a big amount, that may be a tool that you can use. In your book, you have an example of an actual tax return, so you can take a look at the 1040. It really has not changed much. The example you have is from 2010, but the essential information is the same. So you can see there's a section on there for exemptions, so those would be the dependents that they're claiming, for income. And so this section here between lines 7 and 22 is going to be key for looking at what gross income they have. Now, what can you do with a W-2? Well, a W-2 is really useful because that's the year-end statement of their income. And particularly if they've worked that job all year, it's going to be really nice because you can see the year-to-date gross income, and you can also see what withholdings and what deductions they have, not only federal but also state. So this is going to be really useful for calculating gross income, and most of the, at least the tax withholdings are certainly going to show up here, but frequently other deductions will show up on the W-2 as well. But certainly for tax purposes, you'll see the tax deductions. But the W-2 is going to give you that year-to-date information, which can be very useful. Here's an example of a W-2. I'm sure most of you have seen these. So if you look at number 1, that's the box that's going to have the total gross. So number 1 is what you're going to use for gross income. If they bring in statements because they have credit cards or other debts that they're paying on, first thing is you want to make sure they're recent. So you want to make sure that they're within the last 60 days, and that's going to give you the most up-to-date information. And this is also going to be useful in comparing it with the credit report. So if somebody says, hey, you know, I don't know why they said I owe $800 to JCPenney, I only owe $300. And if you look and see, you can say, oh, well, that's because you just paid $500. So this credit report didn't pick up that most recent payment. So it'll help you to identify any discrepancies or potentially any errors. And this is also going to be useful because some clients are really not paying a lot of attention to their statements. They don't really know what the interest is. They're making the minimum payments, and they don't really see how much is only going toward interest. So it can be kind of a nice icebreaker to have that conversation about, hey, do you realize what they're charging you? And to bring up that conversation. So that can be really useful there too. Bankruptcy documents, sometimes there's going to be a lot of pages there, but what you're really looking for is a pretty narrow set of information pieces. You want to look at the discharge date because that discharge date is important, particularly for a Chapter 7. If you remember earlier in this class, we went over the fact that most mortgage lenders will not approve you for a mortgage until 2 years after the discharge date. And clients frequently forget, you know, they're not sure of the exact discharge date, so that bankruptcy document's going to tell you that. If it's a Chapter 13 or even if it's a Chapter 7, you're also going to see a schedule of creditors. And that way you know what has been discharged in the bankruptcy. Frequently, we run into situations where there are still outstanding debts being reported on the credit report, but they were debts that were included in the bankruptcy. So if that's the case, you want to dispute it with the credit bureau, and that way they can show that those were also discharged in the bankruptcy. Counselors should just really kind of be aware of their local lenders and what they're saying about bankruptcy in their markets. For instance, in a lot of markets I've run into, they've said it has to be 3 years after a bankruptcy. So although we're telling you that kind of the general rule of thumb is 2 years, just be aware that that could be different in your particular market. So you might want to get some updated information on that. If a client has a divorce decree, this is where you're going to find out if they have to pay child support or alimony, or if they're receiving child support or alimony, and the amount is going to be spelled out there. Divorce decrees are also going to tell you about who gets to claim the children. So perhaps it's every other year and they alternate claiming it. The divorce decrees should also say who's responsible for what debts. Now, unfortunately, the reality is, regardless of what the divorce decree says, if it's a joint debt, we do know that the fact is they can collect off either person. So even if the divorce decree says that Mr. Smith is supposed to pay it, if he doesn't pay it, they're going to come right back on Mrs. Smith and ask her to pay it. And then at that point, she would have to decide if she wants to pursue Mr. Smith in court because he's violated the divorce decree. And these are known as individual tax identification numbers. And these are issued by the IRS so that someone who's not a U.S. resident can file a tax return and pay taxes. So ITINs are really just for employment and tax purposes. There are some lenders who have created mortgage products, and they're ITIN mortgage products. So someone can qualify for a mortgage based on that ITIN number rather than requiring a Social Security number. So you may be familiar with these, and in different parts of the country they're more popular than others. They've kind of come and gone over the years, but I do understand there are still some ITIN, although there's fewer products available. There are still some products, some mortgage products available, and some mortgage lenders who will loan based on an ITIN. It is important that clients know filing tax returns with a false Social Security number, it is illegal. It's not recommended. Unfortunately, we do run into it. So the fact is, if you have a client who acknowledges that they have filed tax returns with a false Social Security number, they really need to talk to an accountant. At that point, you don't want to advise them of anything other than the fact that it's illegal and that they should talk with an accountant about doing an amendment. And then at that point, they can apply for an ITIN, and that way they could use the ITIN to file taxes and create documentable income. So that they could do through an authorized acceptance agent or through the IRS, that they can apply for an ITIN. So it's just something you will run into. We are finding, hopefully in the future, more and more mortgage lenders will consider ITIN mortgage loans. So we've reviewed how you go over these documents with clients: bank statements, income tax statements, W-2s, if they've got credit cards or other loan statements that they're bringing in, bankruptcy documents, divorce decrees, and also if they have ITINs, and that's how they're documenting and paying their taxes.